Hello, everyone, and welcome to the Buck Stops here. I am Catherine Murray. Well, if you've been watching the markets closely, you've certainly seen that they have been on a tear to the upside. So I wanted to get some great perspective for you in terms of where we are now and where we might be going. And for that, we have a Wall Street veteran joining us. Barry Knapp is joining us. He's the Director of Research and Chief Market Strategist at Ironsides Macroeconomics. Barry, great to be with you. Thank you so much for joining us. A lot to discuss.
Looking forward to it.
Thank you. Barry, let's take a look at the markets, and we're going to start with the U.S. markets. That's obviously your focus, and then we'll broaden out to the macro picture, and that, of course, will incorporate Canada. But when you look at the markets, I mean, the Nasdaq just hit a high recently, and the S&P 500 has been on a tear for the past 3 weeks. A lot of people, or the market perhaps, is telling us that we're going to have a perfect landing, despite the fact that the U.S. Federal Reserve has hiked rates by 500 basis points over the past year. Where do you stand?
That the probability of a perfect landing is fairly low. Um, if you frame out what's gone on since August, really, in terms of the yield curve, which is a very big issue, the curve really needs to disinvert or normalize by 2024 in order to absorb government supply, private sector, real estate related refinancing that needs to take place, private equity, leverage loans. There's just a wall of maturities that we're going to have to deal with in 2024, and the banking system's in no position to absorb that supply. So, you think about what's gone on over the last 3 or 4 months. Initially, the curve was disinverting, but it was disinverting by long rates going higher. That obviously led to the 10% equity market correction. That is the worst possible disinversion path, if you will. It's the insidious bear steepening, long rates going up and raising the cost of finance and housing and a range of other issues. So now what has really taken place is that we're starting to price out any further rate hikes and start to think about rate cuts in 2024. My own forecast is that we'll get 100 basis points of rate cuts, but the Fed is not prepared to start that process yet. To use their language, they're not even thinking about cutting rates as of now. They're still talking about hiking rates. So this is the process that we're going through, and I doubt we can make that transition smoothly because the Fed has changed the conditions, and they did this in September for actually flipping to reversing some of the rate hikes. And I would view the last 75 basis points as almost reckless. They shouldn't have been doing them, quite frankly. And those conditions are not just that inflation comes down, which is what the markets got so excited about last week after CPI, but they actually want growth to deteriorate. And that, to me, making that transition, having growth deteriorate the labor market and consumption is unlikely to be smooth sailing for the equity market.
Well, it's interesting. A couple of points there, and a lot of great points. But it's interesting that you bring up the fact that they want growth to slow as well, because that's what we were kind of talking about, that as they started this rate hike cycle. That if you really read between the lines, that's what they want to do, and it impacts so many people and so many businesses that will really fall and falter because of that. Correct?
Absolutely. And it's not even clear that that's necessary. Most of the disinflationary process has occurred as pandemic-related distortions have come out of the market. The one area that the Fed was responsible for creating inflation was in the housing market, and that's the area that really hasn't even disinflated yet. House prices are 46% above where they were pre-pandemic levels. So it's been pretty, in my view, the rate hikes have been very ineffective. They went about the policy tightening in the wrong way. They should have been more aggressive unwinding their bond purchases and less aggressive with rate hikes. That wouldn't have caused this deep curve inversion, which is an important element, right? A lot of people will talk about how the yield curve forecasts recessions, but it can also cause them. We've only had this deep a curve inversion in 1973, late 79 and 80. The 79-80 episode led to the demise of the savings and loan industry, which was 80% of mortgage supply, credit supply at that time. So I think they've done this incorrectly, and they really do risk causing serious damage to to the labor market in particular.
I want to pick that up on the other side of the break in terms of the potential fallout from this. We'll take a quick break. We'll be right back.